All right, welcome guys to the Death, Taxes and This podcast. Today we've got a very special guest. It's the mortgage broker extraordinaire, snowboarding extraordinaire, footballer retired, Brian Taylor. Welcome, mate.
Thanks,
How are
Joe.
you?
Very well. Thank you.
Thanks for coming in.
Appreciate it, mate. It's a pleasure to be here.
It'd be great to hear a bit about yourself and your background, if you can share that with the guests.
Yeah, sure. So I'm originally from Ireland, so your listeners might pick that up on the back of my accent. I moved to Australia back in 2009. So I did a small stint in the banking industry back in Ireland before I moved across the water. So I started in the banking industry as well when I came over here towards the end of 2009 with Macquarie Bank, and working there for about 5 years in a few various roles. Share trading, home lending, and then from there transitioned out of that role into the mortgage broking space, where I started up Home Equities, and the rest, as they say, is history. So we've been tracking along now for a little over 10 years, and love to say it's been a pleasure for those 10 years, but it's had its ups and downs, but we're still here, which is good.
What made you move out of the bigger corporations and start your own business?
I think I always had it in me to start my own business. I always felt that there was something that I wanted to do, was to actually try and build and grow a business. I think the corporate was a really good way of understanding how the banking system works, and they build their businesses on processes, and that experience really helped me in terms of looking at starting a small business, knowing what it takes to expand and to become a big business. So I think it was just an internal sort of drive that I've always had since I've been a young lad. And as I was working in the home lending space at the time, it was just sort of a natural progression for me to go out on my own and have a crack.
Do you think, like, in your business, like I know it a little bit, you've got two partners, right?
Yep.
You and Donald. How do you split those responsibilities? And did he also have that same drive and passion for starting a business, or you dragged him along?
Yeah, so I did drag him along. So originally, when I stepped out on my own, I started the business. But as we started to grow, I realized that it was becoming a bigger beast than any one man could handle. And it was just one of those things that I was either going to outsource it and have to pay, or bring someone in and have to pay a large salary away, or whatever that so happened to be. And just from a cash flow perspective, that was one of the things that was probably a little bit tight at the time, at the age of the business. So Donald had, over the years, had mentioned to me that he was interested in doing something like this. And just one night we were out and having a chat, and I'd said to him, I'd recognized that I needed somebody in the business to come in and look at that part of it, which was around the operations of the business. So that was where he had experience in. So he had worked in the share trading industry, but he'd also done a stint in the process improvements as well, an operation side of his business that he was working in. So it seemed like a pretty natural fit for him to come in, because that was the area of the business that needed the work. I was happy to take on the front end, being sort of the customer facing side of it. And then it was all just the back end stuff that really needed the attention that I just wasn't able to give it at the time.
Because we only ever see you, Brian, really. So that must be the operations part. He's running back there.
Yeah. He's like the guy who's just chipping away at the back end of everything and make sure it all works. And when everything goes wrong, even the photocopier, I'm just going, Donald, can you help me out here?
There's times where Brian's worked on a few clients of ours, and our own stuff, in fact. And I've had him running around the streets of Sydney last minute trying to get documents to people, and he's out there sweating it up 40 degrees.
I think it was 40 degrees, all right, that day, yep.
So no, he'll do what he needs to get it done.
Yep.
You mentioned outsourcing there briefly. Is that something that you guys do in your business now that you're a bit bigger, or do you keep it all onshore, or how do you get the work out the door? Because you're very busy. Yeah,
so we do. We do have an outsourced team, all right. So we outsource various parts of our business. So if I think of the three aspects we outsource, which is our processing of home loans, okay, which is very highly data entry driven, and We do have a team in the Philippines that helps us with that. We do also have a marketing piece that is also to a degree outsourced, or she's a marketing consultant who works directly with us. And then also from a bookkeeping also as well. So yeah, we do have those three components outsourced. Yeah.
And when did that part come into the business? Because and along the way, at the early part of the business, like what sort of mistakes did you make along the way, and how do you rectify those and learn from that?
Yeah. So as you grow, things that start to come into play are things obviously like wages and salaries and PAYG and super and all of those things that come into the day-to-day of running a business that we just didn't have any experience in that. And we identified that. I think that's kind of one of the key things as a business owner. You got to be pretty quick at identifying your weaknesses as quick as your strengths. So we identified that was a weakness of ours, and that we just needed to get an expert on board to essentially have a look at that and be in a position to go, right, we need to now start looking at bringing someone in who can actually do all of that. And to think back when we've had it a few years now, like, so as mentioned, we're over 10 years in business. So it must be maybe 5 or 6 years with sort of the bookkeeping aspect of it. And same, like we've been just consistently building our outsource team for the data entry component of the business as well. So yeah.
So would you say that was your biggest challenge of running your business at the start, like the people part, or is there like the process part, the lending, getting licensed? For any mortgage broker or anyone who wants to start a mortgage broking business, what are the things they're really going to face at the start that's a challenge?
Yeah, so over the years, I've heard of various ways that people have started, okay? And I think I can probably only really speak on what from my side. So I didn't buy a book. So I know some people go out and they'll acquire a business and then they'll just come in and manage that, and they'll generally have a bit of cash flow from day one. I didn't do any of that. I basically, when I left the business, I just started pretty fresh, bought a list of people in the area that were interested in, that subscribed to property magazines and things like that, and started basically cold calling those people, and hit the streets and went around to businesses, introduced myself. So I did a lot of the old school stuff that was kind of, I didn't know what to do, so I just started, and that was kind of originally where it all began. And then, so that was hard. That was definitely one of the toughest parts of, starting. But when you take away all your income and you're like, right, you got to go and do it, then you've got no choice. You've got to try and make it work. So that was definitely difficult. But as you grow and as your business starts to grow, they're all new challenges that you face. So like I said, as you bring on staff, you then are faced with, okay, well, now I've got to do PAYG, I've got to do employee tax or payroll tax, and you've got to do super and all of those things that come with your business expansion. So obviously that piece to it there was something that we didn't know, and we had to obviously find an expert in that field. And then, as I mentioned, when you're trying to build volume and as the business grows and you have to try and bring people in to help you, the data entry is quite time consuming as well. So they're all just pieces that you have to try and evolve and be pretty quick at doing it as well, because otherwise you start to drown in it, and you end up spending 15, 16-hour days working, which is pretty rigorous on the body.
Well, and also you've got you had a young family, I'd imagine. Well, probably no kids at the time when you started, but you had them pretty quickly after that. So how did you find balancing your family life, kids, wife, football, everything else with work when you're that busy?
Look, I'm very poor at it, to be honest. I'm not going to lie. I actually started the business when my wife was on maternity leave, and we had our first child. So we literally had no income whatsoever. So when people talk about it's not the right time to start a business, I can assure you, when I started, was definitely not the right time. But it's just, there's the saying of jumping out of an airplane without a parachute, and you just got to make it work. So that was sort of my take on it, and just, failure was not an option at that stage. So as the years went on, then customers, as you would know, in a small business starting up, customers are the lifeblood of the business at that stage. And I did spend an awful lot of time on the road. First 2-3 years was pretty, long 14-hour days, 15-hour days, going to see customers in the evening time and doing all the work during the day. So my work-life balance was very poor back then. The one thing I did say, though, at the time when I started the business was that I wasn't going to work weekends. So that's what I've stuck to that ever since. And I haven't actually worked any weekends, which I suppose it's a good thing, So I do the hours during the week, but I still make sure that I kept the hours on the weekend for the family and that. But it's still a challenge, like it's always is finding that work-life balance for sure, mate. Definitely.
It's what we strive for, right? But I think we're probably both very lucky.
Yeah.
We don't work weekends, but
yeah,
it is very difficult during the week.
It
isn't
is.
It, sometimes.
Yeah.
I just wanted to touch on the numbers. You talked about the accounting, the pay-as-you-go, the employees. Does that side of the business come naturally to you, or you don't have that experience and you had to learn that? How did you learn that, or do you just leave it to the experts?
Yeah, look, I can't say it came naturally to me. Obviously working in the industry as well, like when you're in finance broking, you look at pay slips all the time, and it's not like it's foreign to me whatsoever. It was more just a time aspect of it. Like at the end of the day, when you're trying to build a business, your sole focus is to win customers and secure finance for them, and that becomes the ultimate focus. And then as you start to do that and inquiries increase, that's where your focus goes, and then everything else gets left to the side. And that's super important because you can't not pay your PAYG tax and you can't not pay your super. So it was more around just finding the time. And then, as I mentioned, Donal has done a lot of that heavy lifting on our side. So probably one of the biggest piece of advice that I ever would give to anybody starting a business is to have somebody in that role at a very early piece of their business, because you get so bogged down in trying to win business and satisfy customers and give great customer service that part of the business can drop off. So, but in saying that, he didn't know it either. So we still had to get that level of expertise in to show us how to do it, and basically then to just do it for us. So yeah.
Yeah, perfect. How do you track your business performance? Do you look at it as a revenue? Do you look at it as dollars in the bank? Do you look at it as loans settled? How do you sort of track your performance? Yeah,
so we've got a number of metrics that we look at, and we break it down to, if I go from a yearly, we go down to quarterly, because a lot of our stuff happens in quarterly cycles. So we tend to look at what does the quarter ultimately look like for us, with a view, obviously, of the projection into the annual figures. But then that comes all the way down to a weekly or monthly, then weekly submissions of loans, okay, and loan volumes. We've got a fairly substantial amount of data. Again, Donal has tracked on the spreadsheets. We have a performance of every single year, the number of clients we saw, the number of applications we submitted, the number of loans that converted, the number of the volume or the actual details in each and every single one of the loans. So we've got a lot of data on that. And what we do then is we also look at the performance over the years. And if we look at certain years, we try and figure out, well, what was the driver in, let's say, that year? That was, let's say, a year that was quite low. And we can sort of kind of maybe attribute it back to maybe economic climate or whatever that might be, or whatever we've done in that year in the business and what was the driver of that performance. There's a few, it's quite interesting to look back on it actually, because, we've looked at one year where we saw like probably nearly twice as many clients, but still didn't really write as many, like the performance of the business wasn't as great as what it was the following year. And that's about obviously then working smarter rather than working harder. We worked unbelievably hard that year, but we didn't actually make as much, the bottom line wasn't that much better than the previous year. But these are only things that you learn as you go through business ownership and figuring those sort of things out.
What did you learn from that? Was it you were meeting the wrong clients? What changed from those years?
Yeah, I think it was. I think maybe in the age of your business as well, you're probably a little bit more eager to please as well. Like, so whatever customer made the inquiry, we were, it was like, let's go, let's do it, whereas again, that's probably a bit of a learning curve on our side. We start to see that it's not good business practice to go to every single appointment or every single inquiry because of those reasons. Yeah, I guess they're probably the main drivers. It's just that learning curve around figuring out, maybe a little bit more of a qualification with them prior to booking that appointment. Because the way we get paid ultimately is until a loan actually settles, the bank then pays us a commission for that settlement of that loan. So if we're going to see, say, 100 clients and only 50 of them convert, then 50 of them have, we've seen and spent time with a lot of those people that we didn't get paid for. So again, it's just about working smarter than working harder. But I think, just the data is great when you have it, but it's when you don't have it and you're trying to figure it out. That's obviously the hard part. Looking behind side is a beautiful thing in this side of the world. But
what do you see right now because you're obviously front end on the economy, really, when you're seeing house sales, house prices.
Yeah.
What are you seeing at the moment? Are you seeing a lot of turnover of houses, or is it quiet? What are you seeing on your end?
Look, our inquiry level is very high at the moment, for sure. Obviously, rates are always going to be a hot topic in the market. And at the moment, the whole global uncertainty that's sort of floating around at the moment with the US is obviously going to have a little bit of a knock-on effect into interest rates and things like that. But, to date, we've just seen one rate decrease off the RBA, which has been passed on. And I think that just changes a little bit of the customer sentiment as well. The way I sort of look at it is that people are always transacting in homes and buying no matter what. It just seems to be a thing of the Australian economy. People love to buy homes and sell homes. And at the moment, we are extremely busy. We do a lot with investors, though, so there's still quite a strong sentiment with the investor piece as well. So investors are still seeing value out there, depending also in terms of the city you're located in, because obviously if you're buying in the Sydney area and where we're located, its price points are very challenging for a lot of borrowers, particularly your first home buyers. But there's still quite a bit of activity in the market from investors and upsizers as well, for sure.
What are you doing for investors? Like, are you helping them look for houses, like as a buyer's agent, part of your business now? Or?
Yeah. So at the moment, we recently just ticked over on our 10-year anniversary, and we've now we've rolled out a new tiered service model for a lot of our customers, which we've just sort of segmented into a gold, silver, and bronze package, which essentially, in a nutshell, our bronze package, so to speak, is just for people who are looking to get finance. They know what they want. They just need to get the loan sorted, which will help them organize. Our silver package basically is helping customers who aren't quite sure about what they want to do. So some of them are looking at buying investment properties and they're not quite sure of the areas they want to look at. They're not quite sure of their affordability. They want to look at cash flow projections of what an investment property costs them. And we'll do all of that for them, help them around how to actually buy a property as well, just things to look out for as that buying process goes through. A little bit of coaching with that as well. So a lot of people kind of like the idea of it, but once they get into the nitty gritty of spending time trying to find investment property, they realize how tricky it actually is. And then the gold tier package then is ultimately the execution of the strategy. So we'll build out the strategy around price point for them and what that should look like. Rental yields, and then if they want to go into the gold category, it's essentially we'll execute that for them and help them buy the property. So, yeah,
perfect. Do a lot of people that come in and they want those investment properties, they understand the tax side of things well, or is that something that you work with the accountant on, or like depreciation, for example, on a property?
Yeah, a lot of people,
which property and
a lot of people have an idea around it, but they probably don't know the finer detail of it. Okay, so. Again, because property is such a hot topic in Australia, most people know the term negative gearing, say, for example. And if I say, well, do you know what does negative gearing mean? They'll always sort of go, well, could you just explain it to me so that I know that I've got it right, which is understandable. So They do know, but maybe just not the finer detail of it and what it actually means to the bottom line figure in terms of what sort of the tax element is. Obviously not licensed in the tax side of things. We do refer back to accountants. So they do know about it, but just not the finer detail of it.
I love the negative gearing thing. People come in and we want to buy this property and we're going to lose a lot of money on it.
Yeah.
And cash.
Yeah.
Actual cash. And that's great for tax. Or you're losing $1 to save 40 cents.
Yeah.
And then like if they don't have the capital growth, especially at the moment, then you're literally just giving away money.
Yeah. That's it.
And it astounds me.
Yep.
But if you're doing like the depreciation brings you in a loss, that's perfect. That's what people really got to try and plan. Or in high capital growth areas, obviously.
Yeah.
So what are you seeing? Like, where are people buying if you're looking at those at the moment? Are they buying in Sydney or are they buying in regional centres?
Yeah, regional centres more so in terms of cash flow, because you're always trying to weigh up the cash flow versus the capital as well, because obviously you can only project so much into the capital growth of a property, which is looking at certain fundamentals around the area. What's the money spent in the area? What are the government looking to spend infrastructure wise? Things like schools, developments. What is actually happening in that area that's ultimately going to drive the population, which is then going to obviously impact the supply and demand of the area. But that's, again, is anyone's guess. Ultimately, you're looking at the long-term growth of the area, okay? And then you've got to weigh that up then with the cash flow of the property. So how much out of pocket does it look like for you? Because the challenge at the moment, just with interest rates the way they're currently at, is finding a positively geared property is very challenging at the moment. So with that, you've got to really figure out what's an acceptable out-of-pocket expense for you to be able to not have a massive impact on your day-to-day budget or your household budget, with a view that over 10 to 12 years that the property is going to give you that growth in value. But that's part of our tiered service, is to really drill down to see exactly what that impacts your household budget from a day-to-day perspective, and being able to hold the property long term, because as you mentioned, negative gearing can hurt the bottom line, when you're forking money out for a property every week.
Absolutely. It astounds me most of the time.
Yeah. Same.
Have you found like a lot of people using super to make those investments, or you're not?
Yeah, again, I get a bit of both, mate. Yeah, a bit of both. So, again, as you know, there's certain guidelines around sort of super balances that the ATO sort of have in terms of, as I mentioned, guidelines with setting up a self-managed super fund and when it becomes cost efficient for them. So we do quite a few self-managed super funds. Yep, people looking to invest with those entities, and so. To put I guess a percentage wise, it would be maybe 15 to 20% of our volume of self-managed super funds. I've always probably got 3 or 4, maybe 5 of them on the go at any one time. So it just, depends really in terms of customers' appetite as well. Some people just don't have the appetite for buying property in their super. They'd rather just let it sit in the industry fund and kind of have it ticking away. But
what are the on the super side? What are the minimums that you would normally sort of say like someone could be looking at property? Because obviously people have low balances and it's sort of not an option.
Yeah.
But what do you sort of normally suggest for minimum balance, and also what are the rates? Like there's LVRs that the banks lend at for super. That's different to outside of super. So what are those as well? Yeah,
so normally speaking, 200 is probably kind of minimum benchmark that we would look at. Just when you start to plot the data points in, you kind of start to see that outside of that, it doesn't really start making a whole lot of sense for them. The banks are more favorable with the 30% deposit. Okay, so when you talk about interest rates, sort of sub 7%, so 6.8s to 6.9s, give or take here, either side of that on a 30% deposit. Once you go up into a 20% deposit, you're going to be in the mid 7s, give or take as well on that. Lenders have also liquidity requirements. So if you're with a 200K balance and then you're looking to put in a 30% deposit, you're going to be fairly stretched on a quality quality asset, and then you've got to maintain some sort of liquidity in the fund as well. So the bank don't want you to be using all of the cash out of the fund. You got to have some bit of money left in the kitty once it's all done. So it doesn't give you a whole lot of scope for price point wise. So, you know, if you're sitting at that 200, you know, between 550, 600K, you're starting to get a bit stretched, you know, if you're looking at sort of any sort of reasonable deposit on it. So, yeah, it's not a huge aspect. But so someone with 300, you know, now it's kind of, okay, maybe it's sort of starting to make a little bit more sense for them.
That's perfect. Thank you for that. Because we are seeing a lot of people investing through super funds, and we do the tax as well. And some people love property though, don't they?
Yeah.
They only want to invest in property.
Yeah.
Which makes sense a lot of the time. I don't know. For me, it's not always the best returns, is it?
Well, what's your take on it from a tax perspective, like from a balance wise?
Yeah, I mean, I think, well, just to start a super fund, I think you need minimum 200.
Yeah.
Just from a compliance point of view, right?
Yeah.
But I think you don't want to be too over debted in your super fund. And a lot of people don't realize you have to set up a bare trust if you have debt funding in your super fund, which will hold the asset and these kind of things. So there's even more compliance costs, even setup costs. And so, I think minimum 3 to 400. For to buy property.
Yeah.
But you know, you utilize concessional contributions and non-concessional contributions to get the balance higher if you have the cash outside and you work from there. But I mean, some people just buy and sell. You know, we have one that has, I think, 16 properties in their super.
Wow. Okay.
But they've just keep doing it.
Yeah.
Which is great. And they've built up their wealth that way. And some people don't touch it. So.
Yeah.
But it's important that they have the right advisors like yourselves and tax advisors that really get, like, some people, the wrong advisor will just set them up because they want the work, don't they?
Yeah. And that's it. Like, we'll always redirect them back to the accountant to make sure that it is, because I always say as well, like, the lending guidelines are one thing, you know, but whether this is something that you should be doing, then you do need to really get specific advice around that. Because, as I said, if the property turns out to be somewhat, well, it will be most likely negatively geared. And if you don't have a whole lot of liquidity in there and your contributions aren't a huge amount going in every single week or month, whatever your payroll is, it can be quite stressful for people. So you need to make sure that your income is sufficient to support the contributions that need to be made into the fund to make sure that the fund is staying liquid all the time.
We'll change of tact here. But what's the best part of running your own business? Because I know there's people out there that like want to do it. They just haven't done it yet. For you anyway. What's the best part? Is it the money?
Is it the money? No, I don't think it is.
Is it the lack of money?
The lack of money, yeah. I'd say, look, there's probably an element of the flexibility that goes with it, but that's also a downside to it as well, because you are also, like, it is a bit of a ball and chain around your leg as well, because you don't get to knock off at 5 o'clock. So the flexibility is definitely in there. Like, if anytime my kids have something on at school, like, I don't have to write a permission slip to my boss to be able to go to the school concert or something like that. So that's definitely an upside to it. I think, you know, just being a bit of a master of your own destiny as well is probably a part of it for me anyway, is that what you put into it is what you're going to get out of it. And that for me is a big piece to, I guess, enjoying it as well, because, you know, like, I know there's a lot of people that can get very stressed out about running their own business, and it is hard because you don't have that security around that income that's coming in the door every paycheck. So, you know, if it's going to cost you an awful lot of stress, then it's not worth it, you know. So I guess having that flexibility and being that master of your own destiny is probably the two upsides that I would feel as being part of it. And if you're a hard worker, then yeah, there's a financial reward in it for sure.
Do you see, like, how many people come into you that are self-employed compared to employed? And, like, how do you treat those? Are they differently treated on your side? How do you sort of deal with those?
All equal in my eyes, all equal in my eyes. But unfortunately, the banks will take a bit of a different view on the self-employed applicants, just because there's not a level of uncertainty, but there's also adds an element of risk into the fold. Okay, if you check out what the stats are for small businesses, they're not too favorable for us. So the banks do understand and take that on board. So they'll generally look at, I suppose, sorry, just to answer your first question, the majority of my clients will be PAYG, but then the next sort of tier will be PAYG and one of the applicants will be self-employed. Okay. I don't know whether that's a risk on the Australian household where one party might say, I really want to be, do my own thing. And then the other party says, well, if you're going to go doing your own thing, I need to be the one who holds down the solid income here while you go and have a go. But it's rare that you'll have two self-employed applicants. Okay. They do come about, but as I said, it is quite rare. So, and generally from a lending perspective, they're looking at history. Okay. So the banks do want to see a level of history in the industry and what you've been able to do. Okay. Like, unfortunately, someone who's been trading for 6 months and they might be absolutely killing it in the last 6 months, it is extremely difficult to be able to evidence that with the bank. And it all comes down to evidence. What can you show me that is going to support the fact that you can continue, or that you've got a history of being able to produce the results that you've been able to produce in the last 6 months? So we all know as small business owners, like, we'll have some great years, some not so great years. And, a flash in the pan, unfortunately, isn't going to cut the mustard with the bank. So you got to be able to demonstrate history within it. However, in saying that, there has been a few new changes around lending policies for self-employed, which again, I'll just, instead of going into the nuts and bolts of it, I'll just say, give us a call, reach out, because there is avenues there. I know we've worked on a few with you, Joe, to sort of help customers and talk about, self-employed wages and things like that, paying, setting up PAYG systems and things like that to be more favorable for lending. So
I was feeling very seen there for a while, because as you know, I'm self-employed and my wife is an employee. So we're in that situation you were talking about.
Yeah.
And I remember coming to you when we first started out, or very early on, and being like, look at how well we're doing and can we get a loan? And you said, mate, no. So what can people do? It was just too early, right? What can people do when they're thinking of starting a small business or a business, going out on their own, but they're sort of in that position where they're looking to buy as well? Can they get that sorted out before they go, or how do they normally go about it? Or because they are going to go and do that, there's sort of the banks won't touch them. How do they go about it?
Yeah, look, it is a challenge. Like if you're considering buying, then as soon as you become self-employed, then you're going to fall into that credit policy with the banks. Okay, so as soon as you pay your own tax and look after your own super and everything else, then you're deemed as self-employed with the bank. So if you do decide to take the leap and you become self-employed, then you're probably looking at a minimum. You got to have at least 1 year of financials done for any bank to really consider it. There is some of the alternative lenders that are available. So the banks that will look at, well, how has it been tracking for the last 6 months? And they will kind of look at it on a case-by-case basis. And if there's history there, and if there's, a substantial case can be put towards the bank, or I would they're more, I'll call them lenders, but maybe third tier lenders are more specialized lending rather than your sort of majors. They're all going to sit within, well, we need to at least see some sort of history of the self-employed income. So unfortunately, you're generally pigeonholed into that category. And if you go down the sort of alternate doc route, which is bank statements and BAS statements and things like that, you are going to be paying a much higher interest rate. So the trade-off in this is going to be, you go down that avenue today and you want to get a loan in 6 months, well, then we can probably have a look at it. Okay, provided obviously everything stacks up, but you're going to end up paying probably 1% or 1.5%, sometimes even 2% more than what you'd be paying if you've done 2 years tax returns and looking lickety split, and we can look at a major lender with that.
And then you refi at that point.
Yeah, like that's it,
Yeah.
So it's generally a short-term hit until you get your business up and running and your financials are looking solid.
One area that we haven't touched on in lending is the business space.
Yeah.
How common is that in your that you see, and what are people using business loans for generally? Like, are they buying machinery, or are they buying property as well, commercial property? What are you
Yeah.
seeing?
Yeah, so it's probably not a huge chunk of our business. We do sort of, as they kind of come through every now and again. Cash flow can sort of, just depending on the industry as well. So cash flow can be sort of one aspect of a business where people are looking to maybe expand. So they've got quite a healthy business at the moment, and they've got a good business plan in terms of revenue growth, and they want to get maybe a little bit of a line of credit to help them through that first initial period to get staff on board. But they'll have a pretty solid business plan built around that debt, and repaying it will be pretty good, or pretty solid for them. They'll have good profitability. Sometimes as well, like acquisition of businesses as well is another thing. So if there's a business that's looking at acquiring maybe another a service-based industry as well, so that's another aspect of what we've done in the past. So again, looking at a pretty solid business plan, and what does that business that they're looking like currently trading at, and the acquisition of that. So we've done a few of those. Yeah, look, I guess I'm sort of getting into a bit of a mixed bag here, really, when I'm thinking of all of the applications, again, asset finance, or, fit outs and things like that, so businesses looking to acquire other premises and do fit outs. So we've done a few of those in the past as well. So I guess it's a mixed bag, probably not again, a big percentage of our business either, but it's sort of horses for courses with whatever someone's trying to look to do on that. But again, just to come back to being self-employed, you do need to have a pretty solid case and business plan in place to be able to acquire business lending as well.
So if someone's looking to do resi, business, SMSF loans or whatever.
Yep.
How can they track you down?
Well, look, our website is probably the easiest point of contact for us, which is just homeequities.com.au. There is a contact us link within the website. Or send us an email. We're on info@homeequities.com.au. I don't think I'll give out my personal mobile number today.
I wouldn't. Yeah.
I don't think it'll be hopping, but it'll be, yeah. So look, our website is probably just the quickest, easiest to jump on there. We're building out our socials to be a little bit more sort of, bit busier, but at the moment, yeah, website is the way to go.
They can ask us as well, because we're happy to pass on your details.
Thanks, Joe. Appreciate it, mate.
Now, before we wrap up, we're going to ask this to everyone. So I don't know if you've read the question, but what is your least favourite tax and why?
Oh, look, I guess in my industry, it's got to be the stamp duty, hasn't it? Yeah. Why? Look, it's just the biggest barrier of entry for a lot of people who are trying to buy a home. They can generally scrape the deposit together, but then when I hit them with a stamp duty payment, that almost nearly depletes a lot of their deposit. So if we could have a look at doing something at that'd be great. Now, again, I know there is some concessions there, but a lot of my customers who are in the Sydney market are struggling at that level. So
what are the concessions?
Look, 800K, below 800, you're not paying any stamp duty for first home buyers, and then tiered all the way up to $1 million. So but I think the median house price in Sydney is about 1.4 or something like that. So can
anyone afford a house?
Yeah, it's tough. First home buyers, I feel for them at the moment. It is tough at that price point. As I said, just saving deposits are quite tricky. But I always say the first home is never the forever home. So you got to take a hit somewhere, and if you got to get out of the suburb that you really want to be in, and use it as the stepping stone.
Just before we wrap up, on stamp duty, because I mean, if anyone has listened to our last episode, they'll know that's one of my least favourite.
Yeah.
Is there talk? I mean, there was talk previously about restructuring how that looked. Is that something that's still on the table? Do you know, or?
Well, not that long ago, if you don't remember, it might have been was it a year, 2 years ago, maybe, where they had the stamp duty up to $1.5 million. Again, I'm from memory on this 1.5, where you paid I suppose it was almost like a land tax kind of equivalent of
like an annual
tax. So yeah, so at 1.5, like that to me is a lot more achievable for a lot of people, where they can because serviceability for a lot of people is quite achievable. good incomes. It's just the cost of living is holding them back from being able to save that deposit up to that level. So if you put in like $1,000 or whatever it might be, $1,500 for the year for that person on that annual tax, like I found that was a really good program or grant, so to speak, that was available. It did get a lot of heat because the government was saying they don't want to be putting people into an annual tax for the rest of your life. But personally, I'd pay probably $1,500 for the year to help me get in at that price point, rather than not being able to get in. But it didn't hang around for too long.
Nah, so you would support that in future?
I do, yeah, for sure. I do. I think it was a much better option for people to be able to get in. And I had very few clients actually take it up, to be honest. So maybe I'm the one on the other side of the fence for that. I don't know. Maybe it's something I don't see on it, but it just helped. It just helped, like the people who could get in were getting in without the stamp duty. So
I think they need to bring it back, or at least look at it.
Oh, for sure. There's something there needs to happen because it's tough, very tough at the moment for those first home buyers.
There's obviously 4 types of accounting, and 2 of those types, one of them is accounting, as in financials, and that's something we study in CA. And then there's tax accounting. And, you know, when you've studied the accounting stuff, you sort of realize that financial accounting, which is profit and the things the bank want to see, is completely different to tax accounting, which is your taxable profit. So there's lots of add backs and things like that happen in tax. If I use like the big banks as an example, they sort of come out in the paper saying they're posting billions of dollars worth of profit, and that's their accounting profit. And then if you went and looked at their tax return, they wouldn't be paying anywhere near the amount of tax
on that profit
if you did a 30% ratio. Like, they're doing it properly, but it's just all these sort of add backs that go through. Some things aren't tax deductible, but you can put them in the financials. Some things are tax deductible and they're not in the financials. So there's just things like that work. So one of the strategies that me and you have used before is like, obviously the bank wants to look at EBIT when they're looking at a business. So EBITDA, that's earnings before interest, tax, depreciation, amortization. So that's like your cash profit.
Yep.
And just by sending Brian like a, P&L in Xero with a certain format, it sort of like lets me say, all right, this is the cash that they're earning, even though their taxable profit is lower. This is the cash that they're able to get out of the business. And then that will like help the client, 1, pay less tax, but 2, be able to borrow more.
Yeah. And like you said, it's just, for me, is helping you understand maybe how the bank are going to assess that income based on the document that you will give to me. So when I look at that, it's for me is to go right and interpret what each of those, like you mentioned, the accounting and the tax accounting aspect of it, and apply, this is how this bank is going to interpret that document and how that business is performing, and being able to then, I guess, give you that information back in order to be able to help educate your customer to then be able to go, right, well, if you want to be able to borrow money, then we're going to need to do X, Y, and Z to be able to apply to the bank to get X amount of a loan for that.
Yeah, it's funny. So like when Brian and I first met, he was a broker in Balmain, and Joe and I had our office in Balmain, for anyone that wasn't a client then. And I actually said, like, I spoke to Brian and I said to him, I was like, all right, so I've got like a lot of entities and trusts and, like business ventures with different people. So it's a bit of a complex structure. And I said to Brian, if you can get me a loan based on all this sort of information, I'll refer every single person to you that I know, which I have since those years ago that you sort of got me a loan. So he's very, very capable and he knows what he's doing, sort of thing. So yeah, I think, is there anything else we should touch on the subject, or reckon we explain it properly?
Well, like just maybe to when you introduce a number of entities in terms of things like other business ventures and trust entities into the fold, what the bank ultimately want to see in those scenarios is the flow of money, so to speak. Okay, so let's say you've got 4 businesses and a trust, and they want to see, well, where does what relationship does the trust have for each entity that's involved in these businesses? Who's the shareholder? Who's the director? What's the percentage shareholding? How much of a percentage are you, let's say that net profit, what's your percentage ownership of that? If as a 60% owner of the business or a 20% owner of the business, and so on. So it's about tracking the flow of money and then understanding, like we talked about, let's say having a trust entity, because as you know, but
Yep.
your listeners may not, but beneficiaries, you have potentially lots of beneficiaries held within your trust.
What's the go like in terms of like, so the quality of the analyst that's in the bank at the moment, you know, there's been like
Sure.
Unemployment's low. Like I find it hard to find good accountants. So
Yeah.
I can't picture the analysts being like particularly good at understanding all those things. Like, is that what you would see? Because I mean, like I see a lot of brokers that come through the door from clients, and they're friends with clients and stuff like that. And the clients probably know who I'm talking about, and they're just not good at managing that whole process with the bank. And they sort of like then rely on the accountant to go and sign like these ridiculous letters and things like that, so that the risk is all on us. And I don't really like those brokers, which is why I like working with someone who knows what they're doing, because that's less risk for me as well, right? So in terms of the quality of the analysts at the bank, like what do you think of those guys at the moment? Without ripping them too hard.
No, that's all right. That's okay. Look, there's banks that are quite open and favorable to, they've got, let's call it a bigger appetite for the self-employed. Okay. So those types of lenders are always going to be that much easier to work with, because they position themselves in the market to be more ready for it, and they've got the appetite for it. Okay. So from our side, it's about knowing who those lenders are, and then kind of going, right, well, if I'm working with you or with a customer and I've looked at a P&L, so to speak, and I'm kind of thinking, right, well, what bank is going to be favorable to someone like this in their situation? Then we have to try and, I'm not going to use the word mold, but we've got to present a case that is going to be favorable for them around their appetite in that space. So I like to think that those analysts are competent and aren't going to drag you, me, and your customer over the coals to get a finance that you and me both know are well capable of servicing the loan. But it's just about knowing what lender has the appetite for what type of structure and that. So
I mean, that would be helpful. And that's why you go to brokers, right? So
So
I just must have dealt with someone that don't really understand.
Know what they're doing. That's the case with it. And you kind of hope as well that the banks, when an application comes in that has a level of complexity in there, that they aren't just kind of taking them, coming down and just divvying them out, that when a complex structure comes in, you would hope
goes to the top
that
team
it
member.
goes to the person who can handle an application like that. Not always the case, but you know,
so they got to learn somewhere, right?
That's it. Yeah. And a lot of the time as well is like you want someone at the other end who's willing to work with us as well, because at the end of the day, we've put a lot of work into that application.
Of course,
and I'm not in the industry of submitting applications to get declined. So when we submit an application, you would anticipate that they would look at us in a view that goes, right, well, the broker has seen something in this application. They put it together in this manner, and this is how the application is going to stack up. So it's just about us then meeting together and kind of going, yeah, okay, that's it. I see where you're coming from. And, you know.
Yeah, so you've got good relationships with the banks. Like, what's the thing, like, is there's some banks that don't work with brokers? Like, I've ever heard there's a couple, or are they all on board now?
No, there probably is a few. Yeah, like
they'd rather just find their own leads, sort of thing. Because, like, I mean, like, you're helping the bank at the end of the day send them what customers they want.
Yeah.
So that's where it helps. Like, you know, the client doesn't have to pay you. The bank sort of gives you a little tip for that.
Yeah.
But there are some that don't like that. Is that right?
Yeah, there is. Look, you know, it's probably something I don't know a huge amount about, just simply because if they don't want to work with us, we don't really kind of chase them either, you know.
Fair enough.
So that's their prerogative, I guess. The other side of it is as well is that, like, when brokers are writing 70% of the volume in the marketplace, that's quite a substantial amount. And sometimes some of those lenders don't have the infrastructure in place to deal with that type of volume.
Yeah.
And it may not be a case that they're going, hey, we don't want the mortgage broker customers. It could just simply be the fact is that if we turn on the tap here to the mortgage broking channel, we're not going to be able to service that channel.
Yeah.
And
true.
You know, an infrastructure build could be something that's there. So that's kind of what I would
for
assume.
anyone watching, I would always recommend to go to a good broker, because like you said, they're going to know your situation, what lender they want to see, and then they can even dictate like what's important to you. Is it like, you know, having a branch access, or, you know, having a lower rate? Like, so there's a lot of things that can go into that. So yeah, couldn't recommend any more.
Thanks a lot, Brian. Thanks for coming in.
Yeah, Joe, it's been a pleasure as always. Thank you very much for having me.
When's the next ski trip?
Well, the knees didn't hold up too good after the last one, so maybe 2028.
All right, thanks, mate. Have
Thanks,
a great
Joe.
day.
Cheers, mate.
See ya. This is probably the most useful part of the podcast. What do you think? The tax question part.
Yeah.
People can send in questions. podcast@obsidianadvisory.com.au. And we've got a couple of questions in already. So let's start with the first one.
Okay, so when acting as a director, what are the most important things I need to do to protect myself and my assets in case the business goes pear-shaped? Apart from the obvious things like don't do fraud and stuff like that. Yeah, so obviously I think pear-shaped is going to mean, goes into liquidation or doesn't work out.
Perfect question. I think a lot of people, when they start a company, they don't really know their duties, do they? They don't really ask either. So it is very important.
We literally, so like we go to uni, we do prerequisite, then we will do 3 subjects almost just on this, which is funny because there's obviously clients that would just go set up a company. And we've spent all this time studying it. So go into it. There was actually one that I only found out this year, which I know you're going to answer. So I'm very interested. Go ahead.
Yeah. So I do have some notes here because it is a big topic. There's there's the legal side of things, and then there's the practical side, I guess. The practical side is make sure if you have employees, you always pay their super.
100%. And the reason
and on time, if preferably, but
well, so the reason that Joe says that is there's something called the corporate veil, and it means that if you don't do a certain task as a director, and super is like the example that I'm going to use. So like if you don't pay super, it's not the company that ends up being liable for it. It's the director, and you're going to be the director on the company, which means that you personally will be liable to pay their super. I mean, you should be paying their super anyways. But yeah, if you don't pay it, it's going to end up being you personally that needs to pay it. So you can't sort of close your company down and not pay your staff members super.
Yeah. So all of these are really like what will lift the corporate veil, isn't it?
Yeah, correct. It's probably a better way to ask the question.
Because any of these are going to, how do we protect your assets? Company is a separate legal entity. So
and what that means is the company is liable, not the individual. So like when people want to sue something, they're not going to sue Joe, or Luke. They're going to sue Obsidian Advisory, because Obsidian Advisory is the company. You know what I mean? So yeah, what are the things that would avoid that and lift the corporate veil, which means what would make us liable personally rather than the company? Yeah. Which is so first thing is not paying people super.
Not paying super.
Yeah.
Not lodging bazzers on time.
This is the one that I didn't know about. So this is the one that I only found out recently when a couple of our own clients unfortunately had to go into liquidation. So yeah, how many days is it? 90 days. So if you're 90 days late and you haven't lodged your BAS, it's called a non-lockdown. Is it non-lockdown DPN?
DPN, yeah.
Yeah, was unlockdown and lockdown. I think it's one or the other. But basically it means that the BAS obviously gets lodged as part of the liquidation, and they find out how much you owe. And if you're more than 90 days late on lodging it, it becomes the director's problem.
Director penalty. We've seen a few lately.
Yeah, and I've actually seen one of these lockdown ones. I was lucky it was a small amount for the guy, but he was more than 90 days late on one of his BASs. So he's been trading about 7 years, and one of them was late, and he's got to pay that personally. Came into his personal. Yeah,
so summarising so far, super pay on time, or pay on time if you can.
Yep.
Lodge your BASs on time.
100%.
See, what I find with a lot of clients is, not a lot, but when their business starts to go a bit south, they sort of put their head in the sand.
Yeah.
And they sort of go, well, I'm not going to lodge my BAS because I don't want the ATO to know how much I owe them.
Yeah.
That's the complete opposite way of going about it.
Oh, it's ridiculous.
It's a company liability.
Yep.
So just lodge it on time and deal with work through the issues.
100%.
Yeah.
Yep.
So lodge your BAS on time. The other one is don't trade insolvent. So
of course, that's a big one.
That's a big one. And it's part of the legal side of things, which I'll go through. But if you need to be able to pay your debts when they come up, and if you can't, then the company shouldn't be trading anymore, and it should go into liquidation. But a lot of people go on and on and on and on and on, trading insolvent, and that's something where you can really get yourself in trouble as a director.
Yeah. No,
so that's another one.
So basic summary, do you want to go through the 3 high level?
High level.
What can lift the corporate veil? First question, what can lift the corporate veil? Not paying super, not lodging BAS on time, and trading insolvent.
And there are other points that as a director, which we'll have to get a lawyer in, I think, to talk through. But really, it's act honestly. Well, I guess it's the fraud, not the frauds. The question was not doing stupid stuff, really.
Yep.
But you got to act honestly. I've got them here actually. Like, don't avoid conflicts of interest. Don't use information that you have improperly, which is difficult. Like don't buy shares when someone tells you should.
No,
because
that's
they
like,
know,
publicly listed companies.
public, I know, but
not the small private ones.
act with reasonable due care and diligence. So it's really act honestly around all your decisions.
Yeah.
And pay your super.
Yeah.
And lodge your BAS on time.
Yeah. So
and
the thing
don't
is,
trade
like,
insolvent.
you got to lodge your BAS on time. You don't have to pay it on time. If you don't pay it on time, still like the company is liable for that, not you personally.
Yeah.
So just lodge them on time.
Yeah.
Yeah.
Perfect.